Now that we've established what stock is and why corporations issue it, let's talk about how we're going to book it when we do in fact issue that stock. So companies sell ownership in their corporation to raise funds, to raise cash. So whenever you are issuing stock, you are assuming, unless otherwise stated, that you are receiving cash in the exchange. So cash as an asset is going to go up on the debit side, and your credit in the journal entry is to your common stock account or accounts. In our first example here, we are issuing stock at par value. Smart Touch Learning's common stock has a $1 par, and they're issuing 15,000 shares of it. So if we're issuing at par value, that means we're selling it for $1 a piece. Well, if we're getting $1 a piece for 15,000 shares, we're getting $15,000 in cash. So we start the journal entry by debiting cash for 15,000, and then we need to separate the portion of that cash which is attributable to the par value of the stock and the portion which is in excess of the par value. Well, since we're issuing at par, there is nothing in excess of par value. So we have but one credit, and it is to our common stock $1 par value account. And you find that amount by taking the par value of the stock and multiplying it by the number of shares issued. So we're issuing at $1 per share, that is the par value, times 15,000 shares, it's 15,000. We would credit common stock $1 par value, which is an equity account, for $15,000 when we issued common stock at par. Issuing stock at par is not a completely normal thing. Like I previously stated, a lot of companies have par value way below the going market value of their shares, and when they choose to issue new shares, there's no reason for them not to maximize the amount of cash they receive by issuing at a price which is similar to the going market value of their stock. So in this example, Smart Touch is going to issue at a premium, entirely common situation for companies. So they're issuing an additional 3,000 shares, and they're doing so this time at $5 per share. Well, the stock still has a $1 par value, which means there's a $4 difference between the market price that they're issuing for and the par value, which is stated on the stock. That difference is the premium, and it's going to be recorded in an account called paid in capital in excess of par-common, which is a lot to write on a line, so I typically just call it a PIC account, PIC-common. You're more than welcome to do so yourself. So how do we set up this journal entry? Well, what are we receiving by issuing these shares? We're getting cash. So the amount of cash that you receive gets debited, and it's found by taking the issue price, or the market value at the time that you're issuing it, times the number of shares that you are issuing. So they're selling these shares at $5 a piece, and they're issuing 3,000 shares, which means they're getting another $15,000 in cash. We're going to debit cash for $15,000. We have to separate the portion of that cash that we raised, which can be attributed to the par value of the stock, from the portion which was paid in by our now shareholders that was in excess of the par value. So starting with the portion that goes towards par, you're going to credit common stock $1 par, and find that amount by taking the par value of the stock and multiplying it by the number of shares issued. So we have a $1 par for 3,000 shares. We're going to credit our common stock $1 par value account for 3,000. And then the other portion is the excess above par, your PIC account, your paid in capital in excess of par account. Well, since we're issuing at 5 and there's $1 par, we're getting $4 in premium per share. So let's multiply that $4 times the 3,000 shares that we were issuing, and that comes out to $12,000. So we would have a credit to our PIC account for $12,000. And when we display this on the stockholders' equity section of our balance sheet, we need to do a few things. First, we got to display the portion of funding which came in from issuance of common stock, which is attributable to par. And we had two entries previously. In this one, $15,000 of it was attributable to par because we credited common stock $1 par for 15 grand. And in this entry, $3,000 of that issuance was attributable to par. And those two together make the $18,000 that we have in common stock. When you display the amount of common stock that you have on your stockholders' equity section, you're required to do a few things. First, denote what the par value is. That's why we used it in the journal entry itself. So this is common stock with a $1 par value. You need to say how many shares have been authorized by your board of directors. And here we're just going to assume that Smart Touch Learning has 20 million shares which are authorized. And then you need to display the number of shares that are issued and the number of shares that are outstanding. So the number of shares issued are the portion of that authorized stock which you have actually issued to the public. Let's go back one more time. We issued 15,000 shares in this journal entry. We issued 3,000 shares in this journal entry. That's a total of 18,000 shares which have been issued. Shares outstanding is the portion of those shares which have been issued which the public still owns. We haven't bought back any of those shares yet. All 18,000 of those shares are still in the hands of the public. So we have 18,000 shares issued and outstanding. So our common stock $1 par value account with all the information about how many shares have been authorized, issued, and outstanding has a value of $18,000. And then we have our PIC account, our paid in capital in excess of par on common stock transactions account, which has a balance of $12,000, all stemming from this journal entry right here. And in total, we've received $30,000 from people buying equity in our corporation, which is true if we go back to our last two journal entries. And this one, we got cash of $15,000. And this one, we also got cash of $15,000, and that totals up to 30 grand. So our total paid in capital is $30,000, and that's one portion of stockholders' equity, the amount that came in from outside parties. The other portion is the amount that the company has made from its own internal operations. And let's assume right now that Smart Touch Learning was profitable during the period, and they are, as of now, carrying a balance of $3,550 in their retained earnings account, which again is their income they've chosen not to distribute in the form of dividends. Well, if we have $30,000 in paid in capital and we're holding on to $3,550 of retained earnings, that means that our total stockholders' equity at this point would be $33,550. If you live in a place where you're fortunate enough not to have to worry about par value, well, then you have no par stock. And the issuance of no par stock is pretty simple. The two entries that we just had, we issued these shares at $1 a piece in the first one and got $15,000 cash. Well, we don't have a par value. Let's assume in an alternate universe we wouldn't have a par value. We would just credit common stock no par value for $15,000. And the second entry that we did, we issued 3,000 shares this time above what the par value stated on there. But if they didn't have a par value, well, we wouldn't have to worry about separating the portion that's attributable to par and the portion that's in excess of par because there is no par. So for that second entry, we would have a debit to cash of $15,000 and a credit to common stock no par value for $15,000. So if you are allowed to account for stock which has no par value, it's pretty simple. You just always credit your common stock account for the amount of cash that you're receiving. There is no need to split it into the portion that goes towards par and the portion that was in excess of par. And when you display it on your balance sheet, it would be the same situation, but now you don't have to have a PIC account because nothing can be in excess of par if there is no par value. So you would just display your common stock with no par value, again denoting how many shares your board of directors has authorized, how many have been issued, and how many of those that have been issued are currently outstanding, and that is your entire paid-in capital. Add to your retained earnings, you would come up with the same stockholders' equity. So no par stock is much easier to account for than stock with a par value, and I feel like every corporation, if they could just get rid of par value, they would, but it's not allowed by the SEC. GAAP requires you to separate into par value if you operate in a state which has par value, and New York does. So we're going to have to deal with it. What happens if you are issuing stock for something besides cash? Well, it happens. If you want to acquire an asset and you don't have the free cash flow to go out and buy that asset, and you don't want to take out a loan to get the cash to buy that asset, another option is just to give whomever you're buying that asset from shares of your common stock. And the first thing you need to do when you're doing this is figure out what the fair market value of the asset you're acquiring is. So in this case, Smart Touch Learning is getting furniture, and that furniture has a fair market value of $18,000. We're considering that to be the consideration we are receiving for issuing the stock. So we would put the furniture on our books. It's an asset account, so it goes up with a debit by debiting furniture for $18,000. It's fair market value. Well, what we'll be giving up in exchange? It tells us here that we're giving up 5,000 shares of our $1 par common stock. Well, a portion of those assets that we are acquiring can be attributed to the par value of our stock, and we have to separate it. So we're going to credit common stock $1 par value by finding the par value of that stock multiplied by the number of shares that we are giving up in exchange for this furniture. It's $1 par value stock. We are giving this furniture retailer 5,000 shares. That means that common stock $1 par value has to be credited for 5,000. So what we're doing here is we're giving up stock with $5,000 worth of par to acquire an asset with a fair value of $18,000, which means we are getting $13,000 more in consideration above the par value of the stock that we are issuing, and that is our paid-in capital in excess of par common. So if you are not issuing for cash, you're instead acquiring another asset, well, the amount that goes into your PIK account is simply the difference between the fair value of the asset you're acquiring and the par value of the shares that you are giving up in the exchange. And in this case, that would be $13,000, so we would credit PIK common for $13,000. Preferred stock is very similar. You're only really changing the amounts of, or the names of the accounts you have from common to preferred. So Smart Touch Learning is issuing 1,000 shares of its $50 par 6% preferred stock on January 3rd, 2019 at $55 a share. How will we record this? Well, cash is going to be debited for the actual amount of funds we're receiving. We're issuing these 1,000 shares at $55 a piece, which means we'll be receiving $55,000. So let's debit our cash account for $55,000. We have to separate the portion of those assets we are acquiring, in this case cash, into what came from the par value of the stock and what was paid in excess of par. So to find our credit to preferred stock with a $50 par value, we take the par value of the shares, the $50, multiply it by how many shares we're issuing, which is 1,000, and $50,000 of that $55,000 in cash we're receiving can be attributed to the par value of this preferred stock, which means the other $5,000 has to be in excess. And again, you can always find it by finding the difference between the actual issue price and the par price. In this case, since we're issuing at 55 and the par is 50, we're getting an extra $5 per share. And then multiplying that difference by the number of shares being issued, which is 1,000, that's $5,000. We're getting in excess of the par value of our stock. So we're going to denote that by crediting paid-in capital in excess of par preferred, or PIK preferred if you want to shorten it, for $5,000. And on your stockholders' equity section of your balance sheet, if you have preferred stock and common stock, you have to treat them in different lines and again display their PIK accounts. So you would start by showing off your preferred stock, again denoting its par value, how many shares have been authorized, how many of those authorized shares have been issued, and how many of those issued shares are still outstanding, still in the hands of the public. So in this case, we have preferred stock, $50 par. Let's assume our board of directors authorized 2,000 shares of stock, of which we just issued 1,000. And since we haven't bought any of that back, the public still owns that 1,000 shares. We have 1,000 shares issued and outstanding. And we got $50,000 right there. We recorded in that transaction. So we're going to denote the value of that account for $50,000. Associated with it is the PIK account, the paid-in capital in excess of par preferred account for $5,000. Let's list that underneath the account that it's tied to. So we have a $5,000 balance to PIK preferred. And then for common stock, at this case, let's say that we've had our common stock with a $1 par has a value of $23,000, and we'll show off the number of shares that are authorized, issued, and outstanding. And underneath that, we would put in its associated paid-in capital account. Let's say at this point their paid-in capital in excess of par and common stock is $25,000. To find your total paid-in capital, you just add up the sum of everything that's above it. So $50,000 plus $5,000 plus $23,000 plus $25,000 is $103,000. And add to that your retained earnings, and you come up with total stockholders' equity of $106,550.